So the current situation in the gas market, both on spot and forward, is very interesting in the sense that we see low prices. Spot on TTF is hitting levels of 10 to 9 euros per megawatt hour on a day-to-day basis. Forwards have the tendency to hit below the 19 to 18 euro per megawatt hour mark, with even a further tendency to go down further along the curve, depending on the calendar year you're looking at. And it all comes back down to the basic rules of supply and demand, in which we can clearly see that 2019, at least the first half of this year, differs from the same period last year. The supply situation is very good. We have ample pipeline flows coming in from Norway and Russia, with both countries hitting record high levels on a monthly basis. May alone marked a record high period. And you can clearly see that Gazprom is picking in those places that were left behind from the declining local production. Looking at the Netherlands, for example. If we look at LNG, there we can see a similar situation. Ample flows coming into Europe, where we can clearly see that this year global supply is outpacing global demand growth, and the excess surplus in the market is being absorbed by those liquid European hubs, TTF or NBP. On the demand side, we can see that the situation is in slight decline compared to last year. We haven't had a fierce winter, so there was no real heating demand. Storage levels were high during Q1 and are high at this moment. We're around 64%, where we were at 45 something last year out. So the injection exercise for next year is not all that difficult. And also you can see that industrial demand is slowing down. And this is something that we can see globally as well, with the exception of the fact that gas demand for fuel for power installations is slightly increasing, depending on the region. If you look, for example, at the Asian market, there we can clearly see that the nuclear capacity, for example, in Japan, is offsetting the gas market evolution. And a third element that has an effect on current gas prices, both spot and forward, is the oil market indexation, where we can clearly see that oil is a bit in dubio with a lot of geopolitical tensions and also economic uncertainty. The relations between US and China, but also with the Mexicans and even the European Union, is creating a downward trend in terms of financial expectations, and we can clearly see this affecting oil price evolutions with an indirect link to long-term gas indexing as well. Best advice that we can give you at this moment is just be aware of the situation. Gas prices are low in terms of spots and also forward, so be prepared. Note that the balance is often very thin and there is still a lot of volatility, and we've seen it in previous months as well. Price increases can occur rapidly fast with high levels of price adaptations. For spot indexation, so for the short term, I think you can leave open a lot of volume for Q3. Of course, this depends on your risk strategy and also those previous transactions you did in the past. Current spot can optimize those hedges that you did at a much higher price level. In terms of forward indexation, so the long term, it's best to take advantage at the moment that the trend reverses and try to lock in as much volume as possible, as far as possible in the future. So the current situation in the gas market is really beneficial for the energy transition, in the sense that low gas prices combined with higher carbon prices push utilities to burn more gas instead of coal for the power production. So big emitting countries can actually reduce their emissions by using much more gas in terms of their power production. So there is this potential for more fuel switching, but on the other hand, even if the emission rates of those efficient gas units are lower, they still emit CO2 in the air, and on top of that, the natural gas itself is still a fossil fuel.